If you have a fixed rate mortgage locked below 5% and you've been making extra principal payments every month, you have been handing the bank fresh batteries while the Federal Reserve is about to drain them for you. And I'm going to show you, using the Fed's own balance sheet, a published BlackRock institutional paper from 2025, and the incoming chair's actual Senate testimony, that this is not a prediction. It is the most documented financial playbook in modern American history. They ran it from 1946 to 1974, and it worked so completely that the economists who studied it called it elegant. It is about to run again. And your mortgage, the one your loan officer wants you to pay off early, the one Dave Ramsey built a radio empire telling you is a 4-letter word, is sitting directly on the winning side of it. Let's start with a number that makes the rest of this make sense. As of April 2026, the United States owes $39 trillion. Not projected, confirmed. The Treasury's own daily report, the US Department of the Treasury's debt to the penny dataset, puts it right there. 39 trillion. And the Congressional Budget Office just published that the federal government will spend $1 trillion this year in interest payments alone. Not principal, not programs, not defense, just interest. Fortune magazine ran the math in April 2026. That's $88 billion a month in interest, which is roughly equal to what we spend on defense and education combined per month for the privilege of having borrowed the money in the first place. Now, here's what makes it worse. About 1/3 of all existing debt held by the public, roughly $9.3 trillion, was scheduled to mature in the 12 months ending March 2026. So in 2025, roughly $9.2 trillion in marketable debt, about 1/3 of the entire Treasury market, and nearly 1/3 of GDP matured and had to be rolled over. Imagine if your mortgage reset every single year. Not your balance, your interest rate. Whatever rate was on the street that month, that's your new payment for the next 12. If rates are low, you sleep fine. If rates are high, you sell the car. That is Washington right now, every single year. And the CBO projects, interest payments will grow from $1 trillion in fiscal year 2026 to $2.1 trillion by 2036, increasing by 106% over that budget window, faster than any other major budgetary category. Not defense, not Medicare, not Social Security. Interest on money we already borrowed is the fastest growing line item in the federal government. Interest will exceed Medicare spending by fiscal year 2028 and will become the single largest federal government expenditure by fiscal year 2048. So when you see the number and someone says, don't worry, we'll grow our way out of it, ask them what the growth rate is. Because as of March 2026, total gross national debt is $38.86 trillion, $2.64 trillion higher than 1 year ago. The debt isn't just big, it's accelerating. Over the past year, the rate of increase averaged 7.23 billion per day, 301 million per hour. There is no political will to cut spending enough to close this. There is no tax base large enough to collect enough revenue to close this. The math leaves exactly one option that governments throughout modern history have used when the debt becomes this large relative to the economy. And in a few minutes, I'm going to show you why every single piece of the infrastructure for that option is already in place. But first, you need to understand the mechanism, because most people think about inflation the wrong way, and that's exactly why they end up on the wrong side of it. Think of a dollar as a battery. The charge inside is the purchasing power. The dollar itself, the paper, the account balance, the number doesn't change. The number on the battery stays the same, but the amount of charge it holds, the amount of real stuff you can actually buy with it, that can shrink. That's inflation. The battery drains. A dollar that bought a tank of gas in 2020 buys maybe 2/3 of one today. Same dollar, less power. Now here's where the metaphor earns its keep. Debt is just somebody else's dollar. When you owe the bank $300,000, you borrowed 300,000 fresh, fully charged batteries. You have 20 or 30 years to pay them back. And inflation is an equal opportunity power destroyer. It drains your batteries and the bank's batteries at exactly the same rate. So if you borrowed 300,000 fresh batteries in 2021, and you pay them back over the next 20 years during a period of consistent inflation, you are handing back drained batteries. Same number on the side, 300,000. But each one holds less charge. The bank got every dollar they were owed. They just didn't hold much power by the time they arrived. This is the battery drain, and it's the central concept I'm going to come back to throughout this video. The question isn't whether your mortgage gets paid off. It's how much real power those future dollars hold when you send them. Now, the second best piece of evidence I'm going to give you today is a historical document, and it's sitting in a publicly accessible paper published by the largest asset manager on the planet. In July 2025, BlackRock published their analysis noting that financial repression, a theme which they expect will command rising market attention, has historically manifested through government intervention across interest rates and sovereign debt investments, particularly in periods of high government debt loads. The paper is called Financial Repression Past and Future. It's on their institutional website. I've read the whole thing. And what it says in plain language is this. After World War II, when the United States debt hit 106% of GDP, meaning we owed more than the entire country produced in a year, the government did not default and it did not run 20 years of budget surpluses to pay it down. US government debt to GDP rose rapidly during World War II, but then steadily declined from over 100% in 1948 to roughly 25% in 1975. And of the nearly 70 percentage points decline in debt to GDP after the war, over 40 of those points were achieved by ensuring that nominal growth rates stayed above interest rates. Translation, they kept the batteries leaking faster than savers could recharge them. Here's how they did it. The government put a rule on the books called Regulation Q. The first component of financial repression focuses on controlling interest rates, specifically attempting to keep the effective interest rate on government debt below the nominal rate of economic growth. As the US government sought to reduce its debt to GDP ratio during the period after World War II, this involved explicit rules capping private sector interest rates, Regulation Q, as well as outright agreement by the Fed to cap yields on Treasury securities. You couldn't earn more than a set ceiling rate on your savings account. The government literally made it illegal for the bank to pay you enough to keep up with inflation. Pension funds, insurance companies, ordinary savers, they got steered, not forced, steered into holding Treasury bonds at yields that couldn't keep up with the drain. The battery leaked faster than the charger ran. And over 28 years, this process eroded the real value of the government's debt by roughly 70% of GDP. Nobody voted on it. Nobody announced it. Nobody sent a letter. The charge just left. Year after year, quietly, until the debt problem was mostly gone. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Now, here's the critical thing to understand. Financial repression has a losing side. It always has one. You cannot drain the charge out of 70% of government debt without somebody absorbing that drain. In the 1950s and 60s, that somebody was the American saver, the person who did everything right, who kept cash at the bank, who bought bonds, who avoided debt and built a nest egg the responsible way. Even with the explicit coordination of the Federal Reserve to directly cap bond yields, the Treasury still needed to run a fiscal primary surplus for most of the post-war period. And this will be more difficult today given the stark demographic difference between 1945 and now, when entitlement spending accounts for around 2/3 of government outlays. So the playbook is documented. The historical proof is sitting in a BlackRock institutional paper. The mechanism is understood by every economist who studies monetary history. The question was always, will they do it again? And now I'm going to give you the best piece of evidence I have. The part that moved this from plausible scenario to this is currently happening. On April 21st, 2026, Kevin Warsh sat in front of the Senate Banking Committee for his confirmation hearing as the incoming chair of the Federal Reserve. One core issue for Warsh went all but unquestioned, his plan for what he calls regime change at the Federal Reserve. He has planned for years to sharply change the way the Fed operates, down to the very definition of the word inflation. Think about what regime change means, coming from the man who was about to control the most powerful monetary institution on the planet. That's not language about tweaking a quarterly forecast. That is a complete overhaul of the operating framework. And the target of that overhaul is the inflation target. Warsh wants those changes to include a regime change in the conduct of policy and a new inflation framework. Currently, the central bank targets 2% annual inflation. He said, we need a new framework, new tools, and I'd also say new communications. Now you might be thinking, isn't he supposed to be the hawkish one? Wasn't he tough on inflation at the Fed in 2008? Yes, and this is where it gets really interesting, because Warsh is not saying inflation doesn't matter. He's saying the way we measure is broken, and that locking in at exactly 2% is, and this is a quote from his testimony before the British House of Lords in 2023, that he has not walked back asking for trouble. He expanded on this at his April 21st hearing. He said he would move away from the Fed's preferred measure of inflation, the core personal consumption expenditure measure, which he dismissed as a rough swag as to what was going on with prices. Instead, he wants to use trimmed mean measures. He signaled his support for trimmed inflation measures, metrics that exclude extreme price changes, arguing they provide a clearer view of underlying inflation. Lower readings from such measures could influence the Fed's decisions on interest rate cuts. Here's what that means in plain language. The official inflation number we've been using to set policy says inflation is at 3.3% right now. The consumer price index rose 3.3% in March from a year earlier, up from 2.4% in February. If you exclude the energy spike from the Iran war, trimmed mean measures might show something closer to 2.3%. So Warsh's preferred inflation ruler, if you swap to it, makes inflation look like it's basically at target, which gives you cover to cut rates even while actual prices are still rising above 2%. That is not an accident. That is the precise definition of keeping the nominal growth rate above the effective interest rate on government debt. That is the battery drain in committee testimony. If confirmed, Kevin Warsh would lead the central bank starting on May 15th. The full Senate is likely to vote on his confirmation the week of May 11th, meaning he could be confirmed before Powell's term expires on May 15th. And according to 5 consecutive years of inflation above the Fed's 2% target, with cumulative price increases approaching 25%. The buying power of the dollar has already been draining for years. Warsh is not starting the leak. He's accelerating it and measuring it with a smaller ruler so he can claim it isn't happening. This is where I want to introduce a character. His name is Ray. Ray is 51 years old. He refinanced his house in December of 2021, locked in a 30-year fixed at 3.1%. He read a Dave Ramsey book around that same time and has been sending an extra $400 every month toward his principal since then. He's also got $160,000 in a Chase savings account. Chase's standard savings account pays around 0.01% annual interest. That's $16 a year, not $1,600. 16. Ray thinks he's being responsible. And by the rules of 1985, he absolutely is. By the rules of the environment Kevin Warsh is about to create, Ray is voluntarily handing fresh batteries back to the very system that is trying to drain them. I'm going to come back to Ray, but first, let me show you the losing side of this trade, because this is the piece of the story that turns your stomach a little bit. The national average savings account rate, according to Bankrate's most recent survey of over 500 banks, sits at 0.38% as of April 26. 2026, significantly lower than the top high-yield accounts paying up to 5%. Top high-yield savings account rates are still running at roughly 10 times the national average of 0.38%. So the spread right now between the savvy saver and the lazy saver is roughly 4.5% annually. On $160,000, that difference is $7,200 per year. Over 10 years, with compound interest, moving from 0.01% to 4.5% on that same $160,000 is the difference between $160,160 and something closer to $200,000. $48,000. That's almost $90,000 of difference. Not from investment risk, from where you opened your savings account. But here's the reversal you need to sit with, because it's the one that changes everything. You think the problem is that you have a mortgage you haven't paid off. Actually, the problem is that you have savings you haven't put to work. A mortgage at 3.1% fixed, with inflation running above that rate, and a new Fed chair signaling he's comfortable measuring inflation with a smaller ruler, that is not a liability. That is a lever. The bank lent you fresh batteries. Every month inflation runs above your mortgage rate, those batteries you're paying back are lighter. The real weight of that payment falls. Here is the math on your actual house, and I want you to hold these numbers in your mind. The 30-year fixed mortgage rate today, according to Freddie Mac's primary market survey published April 30th, 2026, averaged 6.3%, which means anyone who locked in at 3% in 2020 or 3.1% in 2021 is holding a rate that is more than 3 percentage points below the current market. That spread represents real, tangible wealth. Because if you try to replace that mortgage today, your payment on a $300,000 loan would jump from roughly $1,300 a month to over $1,800 a month. That gap, that locked-in spread, is the battery differential. But the deeper math is about what inflation does to the real weight of that fixed payment over time. Over the last 12 months, the All Items Consumer Price Index increased 3.3% before seasonal adjustment. If inflation runs at an average of 3% per year over the next decade, conservative, given the environment, Warsh is telegraphing a fixed mortgage payment worth, say, $1,400 a month in real terms. Today will feel like about $1,040 a month in real terms a decade from now. The number on your statement never changes. The real burden of it shrinks by roughly 25%. Over 20 years, at the same rate, that payment is worth less than half what you paid in the first year in real purchasing power terms. And here's what makes this asymmetric. Inflation also raises your income. If you own a business, your revenues go up with inflation. If you're salaried, your cost of living adjustments track inflation. If you own rental property, your rents follow inflation. Zillow data shows residential rents have increased more than 20% since 2021, and that trend doesn't reverse just because a ceasefire is announced. Your income side of the ledger inflates. Your mortgage payment does not. The gap between them grows in your favor every single year that inflation runs above your mortgage rate. Let me show you what that looks like with Ray's numbers. Actually, this is the right time to introduce the real numbers. Here is where knowing the numbers and building a system around them are two very different things. I built a digital book called The Exit Code, 8 chapters of analysis built on 50 years of actual retirement data, distilled into a mathematical framework for figuring out exactly when you can stop showing up, not maybe someday. A specific date with a specific number. One of the concepts inside it is something I call the 4%. Trap the thing your financial advisor keeps telling you is a rule, but isn't, especially in an environment where inflation runs above that rule's assumptions. In high inflation repression environments, the dynamic withdrawal method I walk through inside the book changes when you take money and how you take it. That matters more than the investment itself. There's also a section on what I call the invisible bill, the $14,000 insurance gap that destroys early retirees between age 62 and 65 before Medicare kicks in. Most retirement calculators ignore it completely. Your advisor probably skims past it. The exit code is less than one dinner out with your spouse through the link in the description. Every year you spend in the wrong savings account or making extra mortgage payments in a repression environment compounds against you mathematically. That's not urgency marketing. That's the math I just showed you. Now, let me finish the story. Here's a setup that most people have completely backwards. They look at a low-rate mortgage and see a debt. They look at a savings account and see a safe pile. The whole mental model is inverted. In a financial repression environment, which is what BlackRock called it in writing, which is what academic economists studying the post-war period called it, which is what the architecture of the current Fed transition telegraphs debt written in fixed-rate dollars is the asset. Cash sitting still is the liability. Here's a story about how this played out the last time they ran this playbook. A farmer in Ohio bought his property in 1945 with a government-backed 30-year fixed mortgage. His neighbors, a couple who had diligently saved their war bonds and kept their money in the local savings bank, watched their bank statements grow by less than 1% a year through the 1950s. The farmer's mortgage payment never changed, but his land increased in value. His crop revenues inflated with the economy. And by 1965, his fixed payment, originally a heavy burden, was so light relative to what his farm produced that it had effectively become invisible. He paid back the bank in full, every cent. The bank got every dollar they were owed, but those dollars bought roughly 40% less than when they'd been lent. The farmer won. The savers who funded that system, quietly and without ever being asked, lost. Not in a crash, not in a market meltdown, in a long, slow battery drain that nobody announced. The people who know this story are currently positioning for the next chapter of it. Some form of monetary policy capture will likely be necessary to make sure that this debt snowball effect continues to exert a downward force on debt to GDP. That's BlackRock saying it, not a Reddit conspiracy thread, the world's largest asset manager. And here's what makes this moment specific. The reason this isn't just historical pattern matching is that the infrastructure for it is already assembled and running right now. The Federal Reserve held its benchmark federal funds rate steady during the April 2026 meeting. The federal funds rate is currently at 3.50 to 3.75%, 5 consecutive years of inflation above the Fed's 2% target, with cumulative price increases approaching 25%. I mean, the batteries have already been leaking for a while. Warsh isn't starting the process. He's locking in the framework that lets it continue. Now, you think the problem is the Fed's rate level. Actually, the problem is the measurement regime they're about to install. Because here's how sophisticated repression works in 2026 versus 1947. They don't need Regulation Q anymore. They don't need to legally cap your savings rate. They achieve the same result by setting the inflation measurement standard to something that reads lower than actual prices, then keeping their target rate calibrated to that lower number, while real prices in the world keep draining your battery at the true rate. It's the same battery drain. It's just administered with a more elegant instrument. Let me stop on that for a second, because it sounds conspiratorial, and I want to be clear that it is not. BlackRock's paper explicitly noted that the need for financial repression is a theme which we expect will command rising market attention. The Richmond Fed has published a retrospective on Regulation Q. Academic economists have written working papers about financial repression in the 21st century. This is discussed openly in published papers by serious institutional analysts. The reason it doesn't get covered on cable news is not that it's hidden, it's that explaining it requires about 12 minutes, and most cable segments are 90 seconds. This is where I need to pause and say the thing that should genuinely make you uncomfortable. Financial repression requires a victim. The math is zero-sum. If the government borrows in fixed-rate dollars and pays back in drained ones, somebody absorbed the drain. After World War II, it was savers, cash holders, people on fixed incomes, people who did what their parents and grandparents told them to do. Save money, don't borrow more than you need, don't risk it on speculation. They got harvested over 28 years, slowly, without a vote. And if you look at who currently holds the most cash in low-yield accounts, the FDIC national average savings rate is 0.38%. While inflation runs at 3.3%, the gap right now is almost 3 percentage points of purchasing power per year being quietly transferred out of savings accounts and into the debt servicing machinery. On a household with $100,000 in a standard bank savings account, that's $3,000 of real wealth quietly evaporated every year. Not taken dramatically, not announced, just gone. $3,000 per year for every $100,000 sitting in a big bank savings account. While the bank takes that same $100,000 and lends it out at mortgage rates that currently average 6.39%. For a 30-year fixed, more than 16 times the national savings rate. And this is the moment in the video where I want to take a sharp left turn on the Dave Ramsey take, because I want to be precise here. In 1995, when savings accounts paid 5% and inflation was steady at 2.5%, paying off your mortgage early was mathematically sound. The arbitrage didn't exist. The batteries were charging at roughly the same rate they were leaking. But in 2026, with the Fed actively managing the conditions for an inflation premium above borrowing costs, and a new chair about to install a measurement framework that makes inflation look lower than it runs, voluntarily accelerating your mortgage payoff is handing back your lever. The bank wins when you send extra principal. You win when inflation runs above your rate, and you invest the difference in assets that grow with it. Now let me tell you where Ray ended up. Ray had $160,000 in a Chase savings account, earning 0.01%. He had been sending $400 extra per month to his mortgage servicer, which at 3.1% fixed on a $280,000 balance, reduced his payoff date by about 6 years. He thought he was being disciplined. I want to give you the $400 comparison. $400 per month sent to a 3.1% mortgage in a 3% inflation environment has a real return of approximately 0.1% per year. It's almost perfectly flat in real terms. The same $400 per month invested in a simple index fund over the historical 30-year average return of roughly 10% per year grows to something north of $900,000. Not because the market is magic, because compounding beats principal paydown when your debt rate is near or below the inflation rate and asset growth is above it. Ray pulled his amortization schedule, looked at the numbers, moved $120,000 from Chase to a high-yield savings account at 4.3% APY, a difference of roughly $5,100 per year in interest income alone. He stopped the extra principal payments. He started putting that $400 into a boring index fund. He did nothing dramatic. He didn't learn options trading. He didn't buy crypto. He didn't call a financial advisor at 1% per year to explain the same concept I just explained in 4 minutes. He just stopped giving away the gift. 3 moves. You can make all 3 this week. Move 1. Pull your amortization schedule tonight. Log into your lender's portal, find the amortization tab, look at your current outstanding balance and your interest rate. If your rate is below 5%, stop making extra payments. The battery drain is running in your favor. Don't interrupt it voluntarily. Move 2. Check your savings rate against inflation this week. Open your last bank statement. Find the interest line. If you're earning less than 1% at Chase, Bank of America, or Wells Fargo, you're funding the debt bailout out of your own checking account. As of late April 2026, high-yield savings accounts at online banks are paying between 4 and 5% APY. That gap on $100,000 over 10 years compounds to somewhere between $45,000 and $50,000 of difference. Not investment risk, just a different savings account. Move 3. If you have equity sitting in your home, know your 3 options for accessing it without destroying the repression benefit you're sitting on. A home equity line of credit. A cash-out refinance at current rates, which would only make sense if you can deploy the capital at a return above the new rate. Or, for some of you in specific situations, a reverse mortgage. Each has a different use case and a different trap. The point isn't to accumulate debt for its own sake. The point is to distinguish between debt that works for you in a repression environment and savings that work against you. Now, I want to land the broader frame before we close. There are 2 roads from here. Road 1, you keep doing what you were told. Extra mortgage payments, cash at Chase. Wait for someone on the news to announce that it's safe. On May 15th, Kevin Warsh takes the wheel of the Federal Reserve and begins installing a framework designed to measure inflation lower than it runs, with Trump's explicit preference for rate cuts regardless of actual prices, pointed directly at $39 trillion of government debt that has to get lighter somehow. Your savings account is the designated absorber. You are the grandmother in Toledo with $180,000 at 0.01%. You funded a yacht for someone else. Nobody called you. Road 2. You look at the 1946 playbook. You read the BlackRock paper. You pay attention to what the new Fed chair said under oath about his preferred inflation measurement regime. You position yourself on the side the math favors. You hold the fixed rate debt. You move the savings. You let the battery drain run the direction it wants to run. And here is the thing that should genuinely bother you. Your loan officer, the one who sold you your mortgage 3 or 4 years ago, has never once called you to say, hey, about that 3% fixed rate you locked in, here's what it's actually worth right now. Here's what you should be doing with the equity you've built. He never makes that call. Neither does your bank branch manager. Not because they're evil, because the minute you understand what they understand, you stop making extra mortgage payments, you stop keeping idle cash in their savings products, and the math tilts away from them. The incentive structure points precisely opposite to your financial interest. Always has. This is the system working as designed. Lazy investing built more fortune than crypto memes. And the people collecting the biggest bills in this system aren't the ones who worked harder or took more risk. They're the ones who read the boring documents, the Senate testimony, the institutional research papers, the CBO budget projections, the documents that explain exactly what's about to happen to your dollar if you leave it sitting in the wrong account. All of this is public. None of it is classified. And still, the average saver's battery is draining right now, quietly and on schedule, at $3,000 per $100,000 per year, while the government's $39 trillion debt problem sorts itself out one drain battery at a time. Kevin Warsh would lead the Federal Reserve starting May 15th, pending full Senate confirmation. The vote is expected the week of May 11th. The battery is about to leak faster. The only question is whether you're holding the debt or funding the drain.